Hi, I'm Jim Jubak, and welcome to this week's Trend of the Week video. This week's trend is faster tightening than expected from central banks. We sort of have started to go, well, maybe central banks won't increase rates as much as expected, as fast as expected, or they won't withdraw their bond buying, has been the Ukraine. The European Central Bank just blew a big hole in the middle of that by basically saying, hey, we're going to accelerate our process of winding down our bond buying, our stimulus. But the fact that this very conservative central bank that has been really watching not so much inflation as growth, which is a perennial problem in Europe, has decided to move ahead on this front, even with a war going on its border, is indicative that, well, the Fed, which announces rates next on March 16th, is probably not going to hold back. The Fed has really committed itself and its credibility to at least raising rates on the 16th. And I think the Fed will go ahead. It will say, hey, ECB can do it, we can do it, and we'll go ahead and do that. This is a chart of the iShares 20+ year Treasury bond ETF. It's an indicator that I use to tell me something about where bond directions are going. So what you've seen is bond prices go down really from here as we become more and more convinced that the Fed is going to raise interest rates. Bond prices go down as yields go up. And then we get to this bottom here, and then we get a counter reaction. And basically people saying, hey, maybe the Fed is not going to raise rates as much as expected, as fast as expected. Or maybe we like the safe haven of treasuries. So we've had a rise in bond prices as yields have gone down. And then we've had this period here where I basically argue the market is saying, we don't really have the foggiest idea of what's going on. On March 10th, the yield on the 10-year treasury pumped back up to 2%. 5 basis points higher. This was on the 7th of March, this yield was only 1.8%. So it's a huge move in this market in a very short period of time. So if you want to look at this and say, how do I invest in this market? I think one thing that conclusion you can draw from this is if you can get back to a point where the yield on the 10-year treasury is 2 or maybe 2.1, you might want to buy it, because I think we've got enough confusion going forward that the yield is unlikely to just jump to like 225 without pulling back again. On the other hand, this is a period of extreme uncertainty. Yields are not going to pop to really high, so this is not a time to put, hope to sock away, your retirement fund in treasuries. Also not a time to take a lot of risk in treasuries. So if you want to try to do a trade to make money out of the change in treasury prices and yields, this might be a time to be very, very careful and do very, very short-term trades. But I think we're not going to see this huge run-up. Remember, only maybe about a month ago, Wall Street banks were talking about 7, 8, 9, 11 consecutive interest rate increases from the Fed. I thought then that was extremely aggressive and wrong. I think there's more evidence now that was too aggressive and wrong. So we're playing in a much smaller sandbox, if you will, but still getting a fair amount of volatility in rates. If you like this video, please like it. Subscribe to my YouTube channel. That way you get notification of when I do a new video, and I'm doing about 3 a week right now. You can go to my free site, jubakpicks.com. It's got 3 portfolios. Or if you want 6 portfolios, which includes some ETFs and some options plays, you can go to my paid site, and that's jubakam.com. And there are links to both of those down below. Thanks for watching.